Apparently, Don, you're very bullish on stocks. I think you see a 20 or 30% rise, all right? Keith, you're very bearish. You've got a big cash position, and you're shorting it. Well, I want to explore the differences in this. Don, what is your case for buying stocks first?
It's really very, very simple. We're about 8% away right now from reattaining all-time high consensus forward earnings. We're going to get there easily just by Brownian motion within a year. And when we are at all-time high forward earnings less than a year from now, then there's really no reason why we shouldn't be at an all-time high level for the stock market, because forward earnings, more than anything else, drive the stock market. It's just as simple as that. To me, it's the base case. Now, I know you can tell all kinds of the tired, bearish stories about, oh, yeah, Italy is going to declare bankruptcy and North Korea is going to bomb South Korea or South Korea is going to bomb Thailand or something. Yeah, I know those risks are out there, but things are improving. We've had already a 50% recovery in forward earnings, but we're still not back to the all-time highs. We'll be there within a year, and when we are, stocks will be at all-time highs too. And that's just for openers. It's really pretty simple.
Keith, why are you raising cash and shorting stocks?
Well, I don't think it's that simple. I don't think that you can look at the world just through the lens of what's going on in America. What I see on a go-forward basis is global growth slowing at the same time that global inflation accelerates, and at the same time, interconnected risk on top of those two things is going to start to compound. So if you look at today, for example, just to use a proxy for risk, the VIX. The VIX has only been at this 15, 16 level, Larry, twice in the last 2 years. In the summer of 2008, which again you recall is not a very good time to get bullish on stocks, and April of 2010, which was a significant drop from there. So I see a pile of risk coming down the pike in the next 3 to 6 months.
All right, let me move on to others. I want to go to gold. Don Luskin, you've been a longtime advocate of gold. Gold, however, looks to be faltering somewhat as the dollar is surprisingly strong. Is gold still a safe haven, Don Luskin?
Well, I've never really thought that gold is a safe haven. In fact, Larry, I don't believe in safe havens. Safe havens, in fact, are always the opposite of what they're called. They're just the things that sucker people in at exactly the wrong time. It was a safe haven to sell stocks in March 2009. That didn't turn out to be so great, did it? It was a safe haven to assume that Democrats would have one-party rule forever 2 years ago. That crashed, too. So gold is not really a safe haven. Gold is just simply a bet that the Federal Reserve is going to have to keep getting looser and looser and looser to support a weakening economy. Now, as we see the economy starting to improve, which is reflected in bond yields going up, gold has started to falter. Now, falter is a big word when you apply it to gold, because let's not forget, we hit all-time highs in gold just 10 days ago. It's one of the most amazingly bullish-looking charts in the world. That said, if you believe, as I do, that the economy is going to improve markedly year over year, that takes some of the bull case away from gold.
All right, so Keith, if the economy improves materially, if long-term Treasury bond rates keep going up, gold goes down. Now, bonds and gold supposed to be safe havens. Do you think they are?
No, gold in particular, and to a degree, I agree with Don on this. I mean, the gold trade, to a degree, is really about the fear of government trade. And I think that the upward thrust about government, spending and deficit spending, et cetera, is maybe in the rearview mirror. I think most people are pretty concerned at this point about government spending, fiat currencies, et cetera. I think as you push forward into the Ron Paul season, if you will, where he can subpoena the Fed and really take his pants down on this, I think that the dollar gets a bid and gold is going to lose its premium, on top of the fact that what Don just said, bond yields over time, particularly positive real interest rates, augur very poorly for the price of gold on a relative basis to other asset classes.
Don Luskin, if we're going to Reaganomics 2.0, and if Obamanomics is dead, that is my dream. And we saw a lot of evidence of that last night with the spending bill getting killed and the tax bill passing. Then I'd want to be in stocks, but I wouldn't want to be in gold, and I wouldn't want to be in bonds. I'd want to be in stocks.
Yeah, absolutely. Of the three, that's just definitely where you want to be. Bonds are a sell, gold is a hold, stocks are a buy. It's really just that simple. By the way, I'm still trying to get my mind around Ron Paul taking his pants down. What was that about?
What was that about, Keith?
It's interesting. It's going to be a very interesting experience. What's going to be interesting, though, is seeing us traverse this reception of bond yields. Now, I think the biggest debate that Don and I, and you can have really on this, Larry, is are bond yields flashing a risk premium that's embedded in inflation? Are bond yields in the U.S. telling us something about the sovereign debt issues associated with our own municipalities or not? I think that it's a little bit of both. Obviously, there's some growth in the system in the U.S. in the fourth quarter. That's not a forecast. The forecast for me on a 3 to 6 month basis is actually that consumption starts to roll over and inflation accelerates and these sovereign debt concerns come closer to home.
Really? Just let me get this
Hey,
right.
folks, hang on. A 3.4% 10-year yield is not forecasting any kind of inflationary collapse or fiscal collapse. That's just ridiculous. That's still a really amazingly low yield by historical standards. And the fact that it's up from 2.5 is a sign that we're not going into a double-dip recession. Guys, it's simple.
Well, I don't think it's that simple. I think you need to open your eyes up to the world. I mean, that's the U.S. interest rate. There's interest rates across the world are busting out to the upside. In November, the biggest down moves that we saw across the world were in global bond yields. Global bond yields are very high. In Brazil, they're getting ready to take interest rates to 11%.
3.5 on the 10-year isn't busting out. It's not busting out. It's just coming back to some degree of normality. Don't be so dramatic.
Again, it's not being dramatic. It's actually being a little bit more wider in scope. The same problem occurred in 2008, Don, which is if you only look at the world from a U.S. perspective, you're going to have a trouble, understanding what's happening outside of that box.
What happened in 2008 was What happened in 2008 was Treasury yields went down. Where were you?
I was in 96% cash when you said it was a good time to buy stocks in September of 2008.
But why are you in 70%
Well, be that as it may, you're
now?
misrepresenting now what happened to yields in 2008.
No, what I'm saying now is that there is an upward thrust in global inflation, okay? The Chinese just saw a 28-month high in inflation. The Brazilians just saw inflation go from 5.2% to 5.6%. Brazilian growth just went from 9.2% to 6.7%. You're seeing the BRICS decelerate as inflation goes up.
What does that have to do with the U.S. economy? You're just cherry-picking stuff that fits your case. There's no inflation in the U.S. economy.
Well, cherry-picking the rest of the world's growth is not
in the Japanese economy, not in the economies which, when you add them all up, add up to 75% of global GDP. Come on.
Cherry-picking, if you cherry-pick all of Asia, all of Latin America, and all of Europe, what do you have left? All you have left is your bull case, which is USA.
All of Europe. Okay, all of Europe. Core inflation 1.1%. That doesn't make your case. Great, cherry-pick that one.
All right, last word, Keith. Go ahead. Last word.
Well, I think the last word is really the forecast. I think you need to proactively predict that global growth is either accelerating in 2011 or slowing. I think it's slowing.
All right, I'm going to leave it there, gentlemen. I have a dream. Larry Kudlow, I believe Obamanomics gone and Reaganomics 2.0 is here. And I think that's pretty bullish for the American economy. I'd be buying stocks and selling bonds. That's just my view. That's only my little view. Keith McCullough, thank you ever so much. Don Luskin, thanks very much.